So welcome back, my dear student. In the first part, I did the amendments and brief provisions for deductions. I think what you need to pick up is three things. Now, a lot of students do a lot of study, but they study from material which is given to them by a lot of teachers, maybe something that you find on the net. But remember, you are giving the papers for ICAI. Now, if you are giving the papers for ICAI, beta, ICAI itself gives you a lot of study material, and my past experience tells me that there are three things they use, and a lot of questions are based directly or indirectly on the data given there. Now, one is the ICAI supplementary module, and you can download all of them from the ICAI site. You will also have them in the hard copy. I would want you to open them today. So before you start the lecture, please have three things in your hands. One is the ICAI supplementary module, the RTP for May 16, and there is a case study module. What are we going to do? All the amendments with their respective questions and the analysis. So we say the supplementary module gives us the amendments, the analysis, and questions relevant. Then the RTP will give you, of course, questions, which I'm not saying will come in the paper in the form in which they are raised, but the RTP will give me an idea of the type of questions that can be asked, and of course latest circulars and notifications. A lot of times students will wonder, there are so many circulars, so many notifications, what are the ones we need to lay stress on? Here is where you will get them. Then case study, the latest case study. It is not necessary that if a case has come in 2014 or 15, it will be asked in the May 16. It could be possible that a case came in 2010, 11, it is asked in the May exams, but mostly the questions will be based on case study. The case study will come from here. So these three we need to do. 95% of it we've already done in the classes that I've given you. So please feel safe. There is nothing new we are doing. 95% we've done in the classes. We hadn't done deductions. So because there were a lot of amendment, we've done the video on the deductions that is up on YouTube. You can watch it. This is the second part. Now, I'm going to look at first, we're going to go through the supplementary. We're going to go through the relevant circulars with regard to the topics here. And of course, we will do the case study in the end. I'm only going to look at things we've not covered in the classes. What we've already covered, obviously you have the lectures and the notes for those. But if there is an amendment I believe is important for this attempt, even if we've covered that, I will be doing that here. So my aim in this particular topic is to cover amendments and circulars of section 6 to 9. I'm expecting a question on these. Now, you're going to open your, I'm not giving you separate notes as it is, there are too many of them. Yes, we will mark in your supplementary module. So you can open, this is your page number 15. You can open page number 15 of the supplementary module. There's a very important amendment here. I'm going to tell you what the amendment is, why it came about, and what is the current position. So we're going to look at residential status. During the course of the classes, I had said for a person being an Indian citizen who leaves India as a member of the crew, and the words were of an Indian ship. Now there was a lot of confusion regarding Indian citizens who were leaving India as members of crew of foreign ships. There was confusion whether this section was applicable there as well. We remember that the basic conditions are 182 and of course there is 60 plus 365. But for people being Indian citizens leaving India during the year as member of the crew of an Indian ship, we had only one basic condition, and I've explained this in absolute detail in the classes. That was one. So are people in foreign ship, people leaving India, going as a part of the merchant navy as a member of the crew of a foreign ship, will they also fall in the exceptions? That was one. Second, while determining the period of stay outside India, it was seen that if a person, let's say the year has 366 days in the year 1516, if a person is sailing and he is sailing for, let's say, 120 days on a ship, his contract is for 120 days. Ideally, so we have 246 days in India. Well, what these guys did was, now to make sure his number of days falls below 181, he will take 46 days out from here and 19 more days, so that makes it 65 more days of holiday now, let's say in Europe. And then he will say that my period of stay was total 366 minus I was outside India on board a ship, and then I was outside India for 65 days, therefore my period of stay is less than 181, therefore I am a non-resident. Both these points have been addressed. So one is, while we look at the ICI supplementary module, he says the CBDT is going to prescribe. Now the amendments basically said that the CBDT will prescribe the manner of computation of period of stay for an Indian citizen being a member of the crew of a foreign bound ship leaving India. Now we are not saying foreign ship, we are saying foreign bound ship. Explanation 2 has been inserted, and you can underline only what I am doing. You can only go through that. That in case of an individual being a citizen of India and a member of the crew of a foreign bound ship leaving India, the periods of stay in India shall, in respect of such journey, be determined in the prescribed manner and subject to the prescribed conditions. Now this was where we left off while I was teaching you. Now in your RTP, and this is what you will open, there is page number A4. Please open page number A4, and you must have these three ready with you. Sorry, A3, my fault. There is page A3 and there is a circular given. You can mark that as very, very important. I'm expecting a question on this in the papers this time. So very important, and this is page A3, and you can keep ticking. There are a lot of things, lot of detailing in the amendment module and RTPs, but since you're studying from me, have a little faith in me. I will do the relevant part. I've been teaching for a long time. I know how the papers will be asking the questions. The trick is in not doing everything. The trick is in doing the relevant stuff, which is what we are trying to cover here. So now he says the basis for determining the period of stay in India for an Indian citizen being a member of a crew of a foreign bound ship, and I am repeating again, he is not saying foreign ship. This is the law as was. There is nothing different over here. He is only saying that Indian citizen who leaves India, we will take only 182 days, so you can ignore that. Now let's start from the analysis. He says, thus under section 6.1, the condition to be satisfied by an individual to be a resident in India are provided. The residential status is determined on the basis of the number of days of his stay in India during a previous year. ये तो बेटा आता ही है. This is what we all know. However, in case of foreign bound ships where the destination of the voyage is outside India, there is uncertainty. This is why the amendment came. So why has the amendment come? There is uncertainty regarding the manner and the basis of determining the period of stay in India for an Indian citizen being a crew member. To remove this uncertainty, explanation 2 has been inserted, and of course in the prescribed manner subject to the prescribed conditions. So this is why he says we are adding. Accordingly, CBDT has in exercise of the powers with retrospective effect from 1st April 15. So that becomes relevant for us. So this is applicable. inserted rule 126 in the income tax rules to compute the period of stay in such cases. What you need to understand is that all these people, when they join the ship, they are given a date of joining, and when they leave the ship, they are given a discharge certificate. So in your mind, you are going to put up something called continuous discharge certificate. Now every member of the crew, he says, in respect of an eligible journey, we will just look at what eligible journey is. His period of stay in India, while we are calculating, shall in respect of an eligible voyage not include. Now this is what it will not include: the period commencing from the date entered into in the continuous discharge certificate in respect of joining the ship by such individual, and ending on the date entered into on the continuous discharge certificate in respect of signing off by that individual from the ship. So ultimately, when we look at the period of stay for these people, the continuous discharge certificate from the date of joining till the date of discharge, this period is stay outside India. So while calculating their period of stay, we will say 366 minus, this time not 65 but only 120, so it becomes 246. Therefore this guy will become a resident, and if in the previous 7 years he has fulfilled 730 days and of course been a resident for 210, he will become a R plus OR. So two things: this holiday period is not going to be now excluded, that is one. The other part, what is the eligible ship? So first of all, we now come to two terms, and you need to understand these two terms carefully. Continuous discharge certificate, this has the same meaning assigned to it in the merchant shipping continuous discharge certificate cum seafarer's identity documents. So it's a certificate given by the ship on which you've sailed to tell you joined on this date, and this is the date your services with the ship are over. That is what we will exclude, nothing more. Eligible voyage. He says a voyage undertaken by a ship engaged in carrying of passengers or freight in international traffic. So that is very clear. There has to be international traffic. For the voyage having originated from any port in India and has a destination outside India. So the voyage having originated from any port outside India has as its destination any port in India. So merchant navy people might sail from Mumbai to Europe, or maybe he is joining a ship in Singapore. So an Indian citizen flies to Singapore and then sails to Europe and then comes to India. So we are now excluding people who are either sailing from India or sailing from outside India but coming to India. Such ships, such voyage is what we will cover. And if a person being an Indian citizen has left India as a part of this voyage, then his period of stay in India will exclude the period from the date of joining till the date of discharge as per the CDS. Now in the RTP itself, there is a question that has been raised on this, which I will do with you. Now that's a similar kind of question we can probably expect in our papers. Now this is the second question in the RTP, which says, and please read carefully with me, Mr. Anand is an Indian citizen and a member of, he says, a crew of a Singapore bound Indian ship engaged in carriage of passengers in international traffic departing from Chennai. So as we can see, the ship is departing from Chennai, it is sailing in international traffic, and he is an Indian citizen. All conditions as mentioned are fulfilled. And it leaves India on June 6th. From the following details, determine the residential status of Anand, assuming that his stay in India in the last 4 years is 400 days and last 7 years is 750 days. So if you notice, what he is trying to tell you is that in the last 4 years it is more than 365, in the last 7 years it is more than 730. But remember, for this person the basic condition is only 182 days. So how do we calculate? He says the date entered into the continuous discharge certificate is June 6th, and date entered into the continuous discharge certificate in respect of signing off the ship by Mr. Anand is 9th December. So now let us look at the number of days We said 366 is the total days. On 6th of June, he has joined. So, first, second, third, fourth, fifth, 5 days of June and 6 days of June, he is in India. Now, how many days is he outside India? So, on 6th of June, he has joined the ship. So, that makes it first, second, third, fourth, 5. 5 days he was in India. So, 25 days of June he was outside India. July he was outside India. August he was outside India. September, October, November, and then 9 days of December he was outside India. This adds up to 187 days. Now 187 days we will subtract from 366, so we get 179. Now he is not in India for 182 days, therefore he becomes a non-resident. So that is the amendment, that is the question that we can expect. You need to remember these provisions. Now coming back to the ICAI supplementary module, right, now we talked about place of effective management. This amendment I talked in my lectures. We said that in case of foreign companies till 1415, the provisions for residential status were based on board of director meetings. If all the meetings were in India, only then was that company a resident, else it was a non-resident. But from 1516, the concept has evolved and changed to what we now call POEM, place of effective management. You should remember that. I discussed it in detail. I even talked about why the amendment came out. Now, if the place of effective management of a foreign company is in India, then the foreign company becomes a resident of India. And if a foreign company is a resident, remember my dear student, the foreign income as well as the Indian income will be assessable. Now, in this over here, there is no further change on page 15. That is exactly what he's talked about. So whether you read page 15 and 16 or not does not matter, because we've already covered that. Before we move on to the next one, let's look at the question he's asked in the RTP with regard to this. It's an interesting question. If you know your law, if you know your amendments, it's a simple question, else of course it becomes a difficult one. Now question 3 of the RTP says, ABC, a Swedish company. Now he's talking about a Swedish company, which means it's a foreign company, which is headquartered in Stockholm, not having a permanent establishment in India, has set up a liaison office in Mumbai in April 15 in compliance with RBI guidelines to look after its day-to-day business operations in India. So it's just a office which is coordinating the activities, spread awareness about the company's products and explore further opportunities. The liaison office takes decisions relating to day-to-day routine operations and performs support functions that are preparatory and auxiliary in nature. The significant management and commercial decisions are, however, in substance made by the board of directors at Sweden determine the residential status of the company. Now, is the liaison office taking day-to-day decisions or policy decisions? Place of effective management has been defined to mean a place where effective policy decisions are taken. So, in case we can go back and read, the place of effective management has been defined, and this is on page 16 of your supplementary module, by OECD on model convention to mean a place where key management and commercial decisions that are necessary to conduct the entity's business as a whole are in substance made. So, the place of effective management is not a place where day-to-day decisions are taken, but a place where key management and commercial decisions. So, you can remember those words, and the question over here gives you a hint very clearly that the significant management and commercial decisions are taken in Sweden. Therefore, we can say that the place of effective management is not in India. Therefore, the foreign companies are non-resident. Now, how does one answer a question like this for 4 marks? So, in the first paragraph, you divide your concept into 4 paragraphs. The first paragraph, you talk about the law. So, you say, the residential status of a foreign company depends upon the place of effective management being a place where key management and commercial decisions are being taken as per law amended by Finance Act 15 the concept of residential status moves away from the place where board of director meetings take place to the place of effective management. So that's your first paragraph. You've told them about the law and the amendment. Second paragraph, from the facts of the case. Now you look at the fact. You say ABC is incorporated in Sweden and the liaison office in India is only taking day-to-day decisions and not the key managerial and commercial decisions. The last paragraph, from a discussion of the above two paragraphs, you write down, we infer that the place of effective management of ABC Limited is not in India. Therefore, ABC Limited is a foreign company which is a non-resident of India for the year 15-16. So divide it into paragraphs. First you write the law. Second you write the facts of the case. If needed, write a third paragraph for correlating the facts, and in the last you just write down your conclusion. Now we come to page number 17. This is a amendment relating to the Vodafone judgment. So I will take you through that. We know that we've talked about, let's say, A Limited, which has investment in an Indian company. Let's say there is a company that is B Limited that owns the shares of A Limited. So shares of A Limited become its investment, and this becomes the holding of an Indian company. We said that if B Limited tomorrow sells to C Limited shares of A Limited being a foreign company, and the transaction taking place outside India, it accrues outside India, it is received outside India, even then, if A Limited, the shares of A Limited derive its value substantially from a company in India, then this transaction of B to C will be deemed to accrue or arise in India. Now that's the law we know that came about after the judgment in Vodafone case. Now the one point is, what is substantial value? That had not been defined. So this here we say value of Indian assets to determine whether the share or interest of a foreign company or entity is deemed to derive its value substantially from assets located in India. So we are now looking at what does substantial mean. In point number 5, you just come, the rest they have only explained what we've already done. So explanation 6, he says, provides the share or interest in a company or entity registered or incorporated outside India shall be deemed to derive its value substantially from assets, whether tangible or intangible, located in India, if on the specified date the value of Indian assets exceeds an amount of 10 crore and represent at least 50% of the value of all the assets owned by the company or entity, as the case may be. So we are now looking at whether this transaction will be accessible in India or not will depend upon whether the shares of A Limited substantially derive its value from assets in India. Which means, one, if I go back and look at, he says, exceeds the amount of 10 crore. So the investment exceeds the amount of 10 crore. And represent at least 50% of the value of all the assets owned by the company or the entity. So if this entity owns whatever is the total value, this must be more than 50% of total assets. Which now means that if A Limited, let's say, owns assets of India worth 11 crores, but its overall assets are 1000 crore, then we cannot say that shares of A Limited, substantially derive the value from assets in India, even if it exceeds 10 crore, because the word is and. So in this case, when B Limited sells to C Limited shares of A Limited, there is going to be no deemed accrual, because A Limited does not derive its value substantially from assets in India. Yes, of course, if over here we say this is 20 crore is the total assets, then this is more than 10 plus it is more than 50%. Therefore, this is now deemed to accrue or arise in India. Now, that is in effect the clarification amendment in section 9. Then comes on the specified date. Control over the management of A Limited, nor does it hold voting power interest exceeding 5% of the total voting power. In that case, there will be no deemed accrual in the hands of B Limited. I hope you are understanding, and I don't want these in too much detail, just exactly what we are doing. So page number 19 pe, you can mark just this part. This is page number 19. The rest you can ignore, children. On page number 20, point number 10, furnishing of information. Now, just a brief, we will remember furnishing of information or documents by an Indian concern. He says an Indian concern will have a reporting obligation now through or in which the Indian assets are held by the foreign company. So we now talk about, let's say this is D Limited. So now D Limited has a reporting requirement. For the purpose of determination of any income accruing or arising in India under 911, an Indian concern has to furnish to the prescribed authority the information or documents in the prescribed manner if any share of or interest in a company or entity registered or incorporated outside India derives directly or indirectly its value substantially from assets located in India as referred to in explanation 5, and such company or entity holds directly or indirectly such assets in India through the Indian concern. So in this case, this company will have to give certain requirements which will be prescribed. We are not going into details. And of course, if they do not furnish the details as prescribed, then there is a penalty. There is a penalty equal to 2% of the value of the transaction in respect of which the failure has taken place. A sum of 5 lakhs in any other case. So 2% of the value in a case where such transaction had the effect of directly or indirectly transferring the right of management or control in relation to the Indian concern. So if by the transfer that is taking place outside India, the control of D Limited is being transferred effectually and D Limited did not report what it was required to, then there is a penalty of 2%. In any other case, there is a penalty of 5 lakhs. Let's move to the next one. This is on page number 21. He says, now these are simple amendments. I will not lay too much stress on these, but then if they are asked even for a mark or 2 in the paper, you must be aware that there is an amendment. In the chapter on non-residents, we talked about how a branch in India and a branch outside India will be treated as separate entities for the payment of interest. Now in case of a non-resident, we say, which is engaged in the business of banking and there is a permanent establishment in India, then as per section 915, he says there is going to be a deemed accrual for any interest. Now these two are treated as separate persons first of all. As per 915, the interest is deemed to accrue or rise in the hands of the non-resident parent. They will be taxable in India. The permanent establishment will be required to deduct TDS under section 195, and in case of absence of deducting TDS as per section 40A1, the interest paid to the parent over there will no longer be allowed as a deduction. So that in the nutshell is the amendment. We are just going to read through it. So in point number 5 he says, in order to provide clarity and certainty. Now this is what I had taught earlier as well. So there is no change as regards our teaching goes, but there is a clarity here. On the issue of taxability of interest payable by the permanent establishment of a non-resident engaged in banking business to the head office, an explanation has been inserted in 915. So accordingly, in case of a non-resident being a person engaged in the business of banking, any interest payable by the permanent establishment of such non-resident to the head office or any PE or any other part of such non-resident outside India. So we are not talking about only the head office, it could be any office outside India, shall be deemed to accrue or arise in India. So that is just clarifying. I believe that was always the rule. Further, he says such interest shall be chargeable to tax in addition to any other income attributable to the PE in India. So the permanent establishment, remember, is an office in India, it's a bank in India. This income is Indian income, this is as it is taxable. Now this interest will also be taxable in India. And clarification is, the PE in India shall be deemed to be a person separate and independent of the non-resident person of which it has a PE, and the provisions of the Act relating to computation of total income, determination of tax and recovery would apply accordingly. So they are deemed to be separate entities. Further, the PE in India has to deduct tax at source on any interest payable to either the head office or any other branch or PE, etc., and would result in disallowance of interest claimed as expenditure by the PE and may attract the levy of interest and penalty. Permanent establishment definition we know include the fixed place of business through which the business of the enterprise is wholly or partly carried on. So the amendment we say is simple enough. Now let's move to the next part, which is page number 22. Now we have a term called offshore funds. I will keep this simple. So offshore funds are funds which are investing money outside India. So they are not investing money in India, they are investing money outside India. It's like a mutual fund, international mutual fund. We have some of them like the Reliance US Dollar Fund, ICICI Prudential Fund, all these international mutual funds wherein people in India are investing money through the mutual fund in international companies. Now for example, I say investing money in Indian Oil Corporation or the Reliance Petroleum is not going to get me high returns, but I have a Russian oil company in which I can invest the money and I will get a high return. Now sitting in India, I might not be able to understand how the Russian market works and I might be scared of losing my money, and to directly go and invest in the Russian market might not be feasible. So these offshore funds help bridge that gap. The only problem was these offshore funds are actually, as I said, operating outside India, but sometimes they have a fund manager which is managing their Indian operations in India. Now because of this fund manager based in India, even if the fund is outside India, sometimes you could treat that as a permanent establishment. The word business connection we've done in section 911 between the fund manager and the fund could be established. Therefore, any income earned by the fund outside India through its business connection in India will be then deemed to accrue or rise in India. So because of these technical problems, most of these funds were not being managed from India. They used to set up their offices outside India, maybe in Singapore and outside, so that they do not come within the ambit of the international or of the Indian taxation. Now, Finance Minister Jaitley says this is not right because what we are trying to do is attract foreign investments. We want them to set up manufacturing units in India and offices in India, and we genuinely want to tax income which we deserve to get taxed on in India. So this is an amendment which is only now making sure that if there is an offshore fund which is working outside India, the mere fact, सिर्फ इस वजह से, the mere fact that a fund manager is in India will not amount to a business connection. Therefore, foreign income will not be deemed to accrue or rise in India. Now that's the amendment. We will just go through it. We said presence of eligible fund manager in India not to constitute business connection in India of such eligible investment fund on behalf of which he undertakes fund management activities, section 9A. So just to give you a reason why the amendment came up, in point number 1, 2 and 3 they have said that, 3 I am reading with you. Under section 6, residential status of a person other than an individual is determined based upon the location of its control and management. As per existing provisions, this is before the amendment, child. In case of offshore funds, and over here you can write down international mutual funds. Offshore funds, we can write down international mutual funds investing in assets outside India. The presence of a fund manager in India, and this is as per existing provisions, the presence of a fund manager in India may create sufficient nexus of the offshore fund with India and may constitute a business connection in spite of the fund manager being an independent person. And we know when we've talked about business connection, even if independent entities directly work only for each other, there is a business connection. Likewise, if the fund manager in India undertakes fund management activity in respect of investments outside India for an offshore fund, the profits made by the fund from such investments may be liable to tax in India due to the location of the fund manager in India, and attribution of such profits to the activity of the fund manager undertaken on behalf of the offshore fund. So any income earned by the fund outside India through that fund manager could be liable to tax. Further, the presence of a fund manager under certain circumstances may lead to offshore fund being held to be a resident in India on the basis of its control and management being in India. Now with regard to this, he says, on account of the fund management activity undertaken in and from India constituting a business connection, अगर हम fund manager को fund के साथ business connection में डाल दे, if we treat that as a business connection, then the fees received by the fund manager gets taxed in India, and income of offshore fund from investments made in countries outside India may also get taxed in India. Due to the above tax consequences, he says, many fund managers who are of Indian origin are managing the investment of offshore funds in other countries without locating in India. Now, that is the law, earlier law. Khatam ho gaya ye. With a view to facilitate location of fund managers or offshore funds in India, Section 9A, so you will remember, has been inserted to provide for a specific regime in the Act in line with the global best practices, with the aim that, subject to fulfilling of certain conditions, of course, we will safeguard ourselves by the fund and the fund manager. One, the tax liability in respect of income arising to the fund from investment in India would be neutral to the fact as to whether the investment is made directly by the fund or through the fund manager, and that income of the fund from investments outside India would not be taxable in India solely on the basis that the fund management activity in respect of such investments has been undertaken through a fund manager located in India. Now all we are saying, and without going into the complications of the wordings, I hope you're listening to me, all we are saying is just because the fund manager is in India, one, it will not constitute a business connection. That's one. Second, location on the of fund manager in India will not affect the residential status of an eligible fund. So the fund and the fund manager are separate entities. That's as simple an amendment so that we can allow the fund manager to be in India. And the fund manager who's handling the fund on behalf of the offshore funds can be taxed only for income it earns, not the income of the offshore fund in India. So you just need to remember that there is an amendment for offshore funds. You need to now go to page number 27, and there is a small but important amendment over there. Now for example, we say, again we take the case of Vodafone A Limited. Now A Limited has Indian assets. We say B Limited owns the shares of A Limited and it is selling to C Limited. We already know that this is going to be deemed to accrue or arise in India. The doubt that was raised was when A Limited declares a dividend. So foreign company is declaring a dividend which is received by B Limited now. Is that foreign dividend also covered by 911? So when we read 911, it very clearly, and explanation 5, which is what I'm going to read for you here. Accordingly, he says, explanation 5 will be applicable in relation to deeming any income arising outside India from any transaction in respect of any share or interest in a foreign company, which is A Limited, which has the effect of transferring directly or indirectly the underlying assets located in India as income accruing or arising in India. The word over here is transferring. So explanation 5 to 911 only deems income from transfer of shares. It does not affect dividend. Therefore, the clarification given by CBTT in circular number 4, declaration of dividend of foreign company outside India does not have the effect of transfer of an underlying asset located in India. The circular therefore clarifies that dividends, and you will mark this as important, declared and paid by a foreign company outside India in respect of shares which derive their value substantially from assets in India would not be deemed to accrue or arise in India by virtue of the provisions of explanation 5. Now those are small amendments we've talked about. Then if you go through page number 29, 30, these are all amendments relating to charitable trusts. I have covered them in the lectures of charitable trusts, like yoga has been added, we know that specifically. Now, yoga has been added. Please understand, since we are doing it, let's go through the points. In charitable trust, we've talked about charity being defined under section 215, and the point that I'm raising now might be a point which can be raised. We had education, something wrong with my spell, education, we had medical, we had relief to poor, we have promotion of sports, we also have preservation of environment, and preservation of monuments, and then we had object of general public utility. A general public utility, we said if a fees is charged, then it will be outside the scope of charitable. And then of course we read that if the fees charge is less than 10 lakhs, then it went on to less than 25 lakhs, then it will still be charitable. We've discussed all of this. This year we know that he's removed the limits of 10 or 25 lakhs and said if the fees charge is less than 20% of total receipts, we will still consider that as charitable. But there is no restriction on charging of fees here. There is no restriction. So educational institutes being schools can charge fees, yet they will remain charitable as long as, of course, they fulfill conditions of section 11, that is, they apply 85%. Now we've added yoga this time, but yoga has been added separately, please remember. So you have a lot of people teaching yoga and charging fees. Now that will still remain charitable because yoga is not covered in the residuary clause. Yoga is covered separately. If you go and check the RTP, so this is question number 4, children, of the RTP. Do it with me. These are points which I believe can be asked in the paper. He says, an institution having yoga as its main object is registered under 12 AA. Its total receipts are 40 lakhs, out of which receipts from business activity is 10 lakhs. Discuss whether the institution would continue to retain its charitable status and be eligible for exemption under section 11 if its registration has not been cancelled. Would your answer be different if the above institution has advancement of any other object of general public utility as its main object and applies its receipts from business activity towards its main object? Now, what is he trying to ask us? He's just trying to ask you that total receipts are 40 lakhs. The receipts from a business activity, which means fees is charged, etc., is 10 lakhs. So if I look at 20% is 8. So 10 is more than 8. Therefore, it does not come within the general public utility category. But this is yoga. This condition is not applicable. Therefore, if it's yoga, even if the fees charged is more than 20% of the total fees, it still remains charitable. And would your answer be different if the above institution had advancement of any other object as its main object? So if its main object is advancement of any other object of general public utility, then because the business activity fees constitutes more than 20% of the total fees, it is non-charitable. Therefore, it will not be covered by section 11 and it will have to pay income tax. It will not get the exemption of section 11. Now, coming back to your supplementary beta, there are points that we've done. There was that when you are looking at accumulation in case of charitable trusts, we have accumulation of 85%. Now that out of that 85% that needs to be applied, you will remember that there was actually applied, there was deemed application, and then there was accumulation for a particular project or process. Now that project, the maximum time limit for accumulation was given 5 years and we were required to accumulate it in securities of 11.5. Now there's a form 10 that needs to be submitted to specify the purpose for which the accumulation is taking place, and from this year you will only get the benefit of accumulation, which means the amount you've accumulated will be reduced or treated as part of applied, उसकी deduction मिल जाएगी, provided this form 10 has been filed before the due date under section 139(1), and of course the return of income must be filed under 139(1). Only then will the benefit be given, otherwise the benefit will not be given.